Hello, I'm Leanne Spar. In this section, we will be talking about the income statement. The specific objectives we will discuss are: we will understand the terms on an income statement, and we will prepare an income statement. Let's begin by defining the terms on an income statement. This is an income statement that summarizes all income and expenses for a company for a given period of time. Gross sales is the total amount of money received from customers. Returns are returns by customers. Net sales is the value of goods and services bought and kept by customers. The cost of goods sold is an amount paid by the firm for items sold to customers. The gross profit is money left over after a company pays for the cost of the goods it sells. Operating expenses are these, and is the company's cost to run the business. Net income before taxes is the amount earned by the company, and the net income after taxes is the income remaining after income taxes are paid. Now let's look at the steps in preparing an income statement. Step 1. Enter gross sales and returns. Subtract returns from gross sales to find net sales. Step 2. Enter the cost of goods purchased and the freight. Add these two numbers. Step 3. Add the inventory on January 1st and the total cost of goods purchased. Step 4. Subtract the inventory on December 31st from the result of Step 3. This gives the cost of goods sold. Step 5. Subtract the cost of goods sold from net sales, which were found in Step 1. The result is the gross profit. Step 6. Enter all expenses and add them to get the total expenses. Step 7. Subtract the total expenses from the gross profit to find the net income before taxes. Step 8. Subtract income taxes from net income before taxes to find net income, which is net income after taxes. Now let's prepare an income statement. Dave Bliss had gross sales of $284,000 last year with returns of $6,000. The inventory on January 1st was $58,000. A total of $232,000 worth of goods was purchased with freight of $3,000. The inventory on December 31st was $69,000. Taxes on inventory and payroll totaled $3,000. Miscellaneous expenses totaled $4,000, and income taxes amounted to $2,400. Now let's complete the income statement. Step 1. We enter gross sales $284,000 and returns of $6,000, and we subtract to find net sales of $278,000. Step 2. We now add cost of goods purchased $232,000 to freight of $3,000 to get total cost of goods purchased $235,000. Step 3. We now add inventory of $58,000 to total cost of goods purchased $235,000 to get total of goods available for sale $293,000. Step 4. Now we subtract the inventory December 31st of $69,000 from total goods available for sale $293,000 to obtain cost of goods sold $224,000. Step 5. Now subtract cost of goods sold from net sales $278,000 to get gross profit of $54,000. Step 6. Now add our expenses: salaries and wages of $15,000, rent of $6,000, advertising of $2,000, utilities of $1,000, taxes on inventory payroll $3,000, and miscellaneous expenses of $4,000. Add those together to get total expenses of $31,000. Step 7. Now subtract total expenses of $31,000 from gross profit of $54,000 to obtain net income before taxes of $23,000. Step 8. Now subtract income taxes of $2,400 to obtain net income of $20,600. In this section, we have discussed the income statement. The income statement is an important financial tool for every business. You will need to go and practice the problems in this section so you will be able to prepare an income statement.